Professor Nam-Yong Lee's long-form editorial, Long, assessing how the expansion of US dollar supply and stablecoin supply affects Korea's USD-KRW exchange rate and economic growth. The nature of US quantitative easing and its scale as confirmed by numbers should be examined first. Quantitative easing is a policy in which the Federal Reserve buys large amounts of US Treasury securities and mortgage-backed securities in order to lower long-term interest rates and the term premium and thereby ease overall financial conditions. After the pandemic, the Federal Reserve's total assets expanded to about $8.97 trillion around the second quarter of 2022 and then declined as balance sheet reduction progressed, falling to about $6.7 trillion around June 2025. The United States broad money aggregate M2 increased sharply in 2020 and 2021, and in February 2021 it recorded an exceptionally high year-over-year growth rate of 26.9%. US M2 is observed at about $22.298 trillion as of October 2025. These numbers show that quantitative easing can significantly shake both the quantity of dollar liquidity and the market's felt sense of financial conditions. The relationship with US economic growth should be interpreted from the perspective of regression analysis. If one wants to examine the relationship between economic growth and money supply scientifically, one must not stop at correlation but must test the explanatory power of regression equations and the stability of coefficients. One must examine whether the growth rate of monetary variables consistently explains the growth rate of real GDP or the growth rate of real per capita income. And one must also check whether the relationship remains when control variables such as interest rates, inflation, unemployment, and fiscal shocks are included. In long time series data, there are periods in which money supply rises during crises while growth rates fall, and this fact can easily distort simple correlations. When control variables and lags are incorporated, the direct coefficient of monetary variables on growth often becomes smaller or fluctuates in sign and magnitude across sub-periods. This observation supports the interpretation that money supply does not function as a single direct cause of growth, but instead propagates indirectly through channels such as financial conditions, asset markets, and exchange rates. The quantitative range of growth effects presented by empirical studies should be stated clearly. Many studies argue that even if a growth effect from quantitative easing exists, its magnitude is limited. Estimates have suggested that large-scale asset purchases can raise the level of real GDP by around the 1% range over a multi-year horizon, or that when the announced size of asset purchases is about 1% of GDP, real GDP and prices can respond in the range of several tens of basis points up to the upper end of several tens of basis points, where 1 basis point equals 0.01%. When converted into growth rate terms, some studies report effects below 0.3 percentage points or below 0.5 percentage points. This range implies that even if quantitative easing reduces the depth of downturns and helps recovery, it cannot replace long-run growth engines such as productivity, technology, demographics, and institutions. In other words, money supply is neutral with respect to real economic growth in the long run, meaning that it does not determine real growth by itself. The reason the USD/KRW exchange rate is central and the transmission path felt in Korea should be explained next. Korea does not issue dollars, but it is an open economy deeply connected to the dollar system, and therefore shocks from US monetary policy often arrive through the exchange rate earlier than through the growth rate. When the USD to Korean won exchange rate rises, import unit costs rise and import prices increase, and energy and raw material prices propagate into consumer prices and the cost structures of firms. When the USD to Korean won exchange rate falls, pressures from import prices ease, but at the same time exporters face adjustments in their won-denominated earnings and price competitiveness. For this reason, When discussing the effects of quantitative easing in Korea, changes in inflation and financial conditions transmitted through the USD to Korean won exchange rate are often observed earlier than changes in growth figures. There are three mechanisms through which quantitative easing can influence the USD to KRW exchange rate. Quantitative easing can work by lowering long-term interest rates and stimulating risk asset preference, thereby weakening the relative return attractiveness of the dollar. In that case, global funds may move toward risk assets and emerging market assets, and this can produce pressure for won appreciation and a decline in the USD to Korean won exchange rate. Quantitative easing can also change the regime of risk sentiment, and in risk-on phases, it can increase the likelihood of emerging market currency strength. However, when markets become unstable and shift into a risk-off phase, safe haven demand can concentrate into the dollar, and this can produce won depreciation and a rise in the USD to Korean won exchange rate. Therefore, the exchange rate effect of quantitative easing is not fixed in a single direction, but has non-linear characteristics that depend on market psychology and on the nature of the shock. The sensitivity of the exchange rate indicated by quantitative evidence regarding the won should also be clarified. Korea's won has been shown to respond sensitively to US monetary policy shocks in quantitative empirical work. Evidence based on FOMC events suggests that tightening surprises in the US policy rate can be linked to won depreciation, while expansionary easing policy and forward guidance can be estimated to affect the won in the direction of appreciation. This result suggests that in evaluating US quantitative easing in Korea, it may be more realistic to interpret the effects through the US dollar to Korean won exchange rate as a central channel rather than to focus disputes on a direct growth effect. The reality of the recent USD/KRW exchange rate cannot be explained by US policy alone. Recent movements in the USD/KRW exchange rate are not determined only by US monetary policy, but show a pattern in which Korea's internal dollar supply and demand conditions and capital flows are strongly intertwined. Factors such as increased overseas securities, investment by Korean residents, the holding of foreign currency by exporting firms, and net selling of Korean equities by foreign investors can raise dollar demand or reduce dollar supply in ways that push the exchange rate upward. Therefore, to understand Korea's exchange rate, one must look at US quantitative easing and the interest rate path, while also examining domestic capital flows and the structural features of dollar supply and demand together. Dollar supply expansion and stablecoin supply expansion have different characteristics. Quantitative easing by the Federal Reserve is a policy that directly changes base money and financial conditions through the central bank's balance sheet. Stablecoin supply expansion is a structural market change in which private issuers create tokens pegged to the dollar, hold reserve assets, and reshape the distribution and transmission pathways of dollar liquidity. As of the end of 2025, the global stablecoin market capitalization is estimated at about $309.5 billion, which is smaller in scale than Federal Reserve assets or USM2, but it has the power to reduce frictions in payments and transactions. This difference means that quantitative easing can affect prices and interest rates immediately, while stablecoins can structurally change dollar demand and dollar mobility as time passes. The structural pressure that stablecoins may exert on the USD/KRW exchange rate should be explained. The diffusion of stablecoins can lower the cost of cross-border dollar transfers and improve access to dollars, and in certain phases it can strengthen preference for dollars. When risk aversion increases, stablecoins can accelerate flight into dollars and increase exchange rate volatility. Conversely, when financial conditions are stable and risk appetite is high, stablecoins may operate in a way that disperses dollar demand by linking with investment into emerging market assets. In addition, if reserve assets concentrate in US short-term treasuries, they can affect US short-term interest rates and the distribution of dollar liquidity, creating indirect channels into exchange rates. All of these impacts vary significantly depending on stablecoin transparency, the quality of reserve assets, and the strictness of regulation. In the end, the observational framework Korea must adopt is an exchange rate-centered relational network. The impact of US quantitative easing on Korea often leaves evidence first in the US dollar to Korean won exchange rate rather than in growth figures. The USD/KRW exchange rate changes households' real purchasing power and firms' cost structures through import prices and inflation expectations, and it connects further to interest rates, debt sustainability, and the volatility of asset prices. Therefore, the indicators for policy and investment judgment include liquidity indicators such as the Federal Reserve's assets and USM2, US long-term yields, and the term premium, global risk sentiment indicators, Korea's overseas securities investment flows and foreign investor flows, and above all the trend and volatility of the US dollar to Korean won exchange rate. When this observational framework is adopted, one does not hastily conclude that one strength during a quantitative easing phase directly translates into real growth, and one also avoids the mistake of assuming that one weakness is merely the result of domestic liquidity. US quantitative easing expands dollars and moves the economy, but it is closer to an amplifier that first shakes Korea's prices and perceived conditions through financial conditions, asset markets, and the US dollar to Korean won exchange rate rather than serving as a single engine of growth. Stablecoin supply expansion is a structural change that can spin that amplifier faster through digital payments and cross-border mobility. And although its scale is still smaller than quantitative easing, it can become a new pathway of dollar demand and exchange rate volatility. The expansion of dollar-based stablecoins under the Trump administration's quantitative easing and the Genius Act strengthens the dollar's reserve currency regime, and it is not fundamentally different from the United States improving its prosperity without improving productivity by extracting wealth from all countries that use dollars, which can be described as a form of breach. Korea's politicians and bureaucrats must design strong measures to protect the working class, small and medium-sized enterprises, and the self-employed who are being pushed to the margins. The nation can survive only when its people stay awake and alert. Thank you for watching Professor Nam-Yong Lee's long-form editorial, Long.